Welcome to Accelerate OC, the only show focused on the people leading innovation in Orange County. Join our host, Kerry Ransom, in his conversations with the trendsetters, entrepreneurs, investors, and leaders here, because it's time to Accelerate OC.
Good morning. Welcome to Accelerate OC. I'm Kerry Ransom, and thanks always to our engineer, Paul, for making me and my guests sound so good. Today's episode is sponsored by my home here, Orange County's first venture studio, OC4 Venture Studio, where we are partnering with exciting founders who want to build the next generation of data-centric SaaS companies. And we will bring investment, a team, and a community around to help them get off the ground and get growing quickly. If you want to learn more or be part of our community, feel free to go to oc4v.com to learn more. I am really excited to have Fred Haney with me here today on Accelerate OC. And before we get to hear from Fred and his amazing experience and wisdom and stories, let me tell you a little bit more about him. He is a longtime private investor, venture capitalist. He was a fund manager and also an individual investor in many, many companies. He's also an entrepreneur as a multi-time co-founder and CEO of several companies such as Novodyne Therapeutics, Dynamic Reconfigurable Computing, and Pulsentry. And as a venture capitalist, he was recruited by a European venture firm called 3i Ventures to establish themselves here in California and had an office here in Orange County for a number of years where he set up 3i Ventures. And they were, for a period of time, the largest venture capital firm in the world. He served on the board of over 30 private companies and 4 public companies. What an amazing set of experiences. And we were talking out there about just the amount of pattern recognition that you're able to get through that kind of set of experiences. So much so that he was able to write a book called The Fundable Startup. And I'm sure we'll talk a fair bit about that today, where he talks about strategies for giving your startup the best opportunity and chance at raising capital. And it really draws on a lot of his years of experience as both an investor and operator. He also, several years ago, but this goes back into, I think, even the mid 1980s, he started a group called the Monday Club, which still goes this day, and I've had the privilege of joining several of his Monday Club events where he connects startups and investors. And he also, as a part of continuing to do that, he was a co-founder of Tech Coast Angels over 20 years ago as well. So he has been hands-on as a professional, and he continues this day to really serve this startup and investor community in so many ways. And I'm personally grateful, and I know many, many others in our community are as well. He has a PhD in computer science from Carnegie Mellon, so he certainly knows what he's talking about from a technical standpoint. He's been a director of the year for early stage companies by the Forum of Corporate Directors. He was named a mentor and angel of the year as well. And he probably should have my job. He's a former radio talk show host and frequent public speaker. So Fred, I'm so appreciative. Thank you for joining me on Accelerate OC this morning.
Thanks, Corey. I'm really glad to be here with you and glad to see if we can help Orange County startups a little bit.
Well, I appreciate that. So let's get to the starting line. One of the things that I really enjoyed reading that you said is startups with a truly good idea should be able to find a path to success. So how would you advise a founder to really reflect on that statement and determine whether they do have a truly good idea?
Let me answer your question a couple ways. First of all, there are a lot of good ideas that aren't necessarily fodder for the top tier high-tech venture capital.
Oh, for sure.
But there's a lot of good ideas that make a lot of money. Some of them are good lifestyle kinds of businesses that might be good cash flow generators. But my primary focus has been on high-tech companies, the Silicon Valley style high-tech. And there, I think one criterion is you got to make sure you're addressing a large market. So you got to do your homework, sharpen your pencil, and really convince people that there is a large market opportunity for your product. You've also got to demonstrate that you've got a very clearly defined, unfair, sustainable, competitive advantage. I mean, that sounds trite, but that's what Silicon Valley venture capital is based on. I mean, the whole idea of those venture capital firms and the early startups was companies that had some kind of sustainable competitive advantage, probably proprietary, probably protected by patents. And the venture capitalists were counting on that to help a small company carve out a significant territory where other big companies like IBM and Intel and all the computer and electronics guys had a lot of space. I think that the other thing they need to do is convince investors, if they're trying to raise money, that they're solving a really important problem. I mean, that's a little more subjective, but you can put your argument together. It ties into my first point that it needs to be a large market, but you also need to be addressing a really significant problem. I mean, just because there's a lot of people who might buy the product doesn't mean that it's compelling. That people really need to have the product. So
yeah,
we talked starting place.
That's a great place. Yeah,
a good place to start.
Yeah, I think it's a great place to start. I mean, we talk a lot here about, I mean, particularly on the problem side, that often we have people that will show up with a solution looking for problems to solve, as opposed to really deeply understanding the nature of that problem. And, a lot of, to your point, there are a lot of problems out there that people just aren't that interested in solving because it's not painful enough for them to feel compelled to do so. And getting human behavior change is never easy. So sometimes a really painful problem is a motivator to get people to act, right? And those are your customers. So,
exactly.
Great point. So I really like that you talk about unfair advantage. One of the things that I feel like we're seeing in this era right now is, it's sort of this shift from, I'll call it technology, meaning software and writing a lot of code, which has become increasingly easier. And you even have things like no code and these other movements, to really a product-centric sort of approach to things. And sometimes IP or other technology advantages are non-existent. So how do you now, in a world where that sort of IP or other moats that maybe historically people had, how do you think about unfair advantage today? Because that technology aspect in many cases is sort of off the table. Like when we look at opportunities, we go, oh, we can get that built. Like getting it built's not the problem. It's how are you going to go execute a great high scale business around it?
Yeah, it's a different world today than it was certainly 20 or 30 years ago. If you looked back in the 80s at the areas, the target industries where venture capital was going, a lot of it was computers and electronics, chips, hard technology. If you look at that list today, there's a lot more consumer products, internet related things, healthcare and biotech are up there pretty high. And especially in the consumer products and internet related things, I honestly don't know how the VCs today sort out competitive advantage. I mean, the whole idea of having sort of patents and defenses and protection that's going to last you 15 or 20 years, it still works in some areas. I mean, it still works in biotech, it still works in medical devices, it works in some other areas. But the Supreme Court's made it pretty hard to patent software. It's very hard to get patents around software. It's very hard to get patents around apps that are going to be out on the internet. And I think the thinking has sort of shifted and I'm not entirely comfortable about it. I still like unfair competitive advantage, uh, but the thinking has shifted sort of in the Amazon direction. First mover advantage, go out and capture a lot of eyeballs and worry later about making a profit. Um, I mean, Amazon's become kind of the new Steve Jobs or Bill Gates, but well, we're here first. We're going to capture a lot of eyeballs. Um, Fine, that's nice to say, and it's often the case that a first guy in who is well funded and can go out and kind of grab a sector of the market may be the survivor. But it's a different game. I mean, it requires a lot of capital. It requires being pretty aggressive. It requires a lot of patience.
Yeah, that's for sure. I mean, I often refer to Amazon as the quintessential venture studio to some extent, because if you really look at what they're doing, they're taking all the additional cash flow that they bring in and they're reinvesting it into new projects and new ventures that they continue to experiment with and launch. And it's pretty impressive to watch. The question is sort of over what time horizon should they be being evaluated? And they've said, hey, we're going to just take the longer time horizon than anybody else, and that's what's going to allow us to succeed, which is a fascinating thing to watch.
Well, they've sure made it work. I guess the question is who was brave enough to jump in at the beginning. That's right. I mean, at the beginning, a lot of people said, how's that ever going to work? They don't really have a profit model. They don't have a business model. And even, I don't know, some years into it, people were still saying, how are these guys ever going to make money? Sure. I guess the people, if I saw this number the other day, I don't remember it. If you bought $1 worth of stock at the beginning, it's worth, I don't know, $300,000 now or something like that. It's just an incredible multiple. But who would have had the guts to make that decision early on? So I see companies all the time who are claiming that they've got first mover advantage. They're gonna get in first. They're gonna get in big. They're gonna capture big share. But how many other guys are saying the same thing?
That's right.
It's a tricky game. It's not as cut and dry as we've got 3 patents around this thing. So I tend, just my personal preference, I tend to steer away a little bit from the consumer products and the apps. I mean, the other problem with consumer products is that I'm not smart enough to figure out which singer is going to get the platinum record. I mean, there are going to be some hits with all these apps coming out, and some of them are very clever ideas, but it's just really hard to know which one's going to take off. And in this last decade, the world's been kind of binary. I mean, you either became a unicorn or you hit the trash heap, and not a whole lot in between.
Well, and I think that's been fascinating and probably something we should be studying more and more as early stage investors, as company builders. I mean, as you're seeing now this great implosion happening with things like SoftBank and as I described it over the last few years, you've seen this scenario where, because unfair advantage has been difficult to really assert, you have all these companies down here at this level that are getting funded by angels and small funds, and the funds at the top have just gotten bigger and bigger and waited longer, and they've said, we'll just wait for one of these to emerge and then we'll drown it in capital to almost ensure that it succeeds. And it's still sort of this open question now of, is that a great strategy? And if there's not a real business there, it clearly is not a great strategy that we're now starting to see. I mean, I saw a headline this morning that said, will Airbnb survive this? And a lot of people were saying that's going to be a amazing long-term success story. So it's a really fascinating time to look backwards. I mean, that's where I always appreciate the perspective from folks like you that have been through multiple cycles, because I want to talk in a minute about what stayed the same, because I will be curious your thoughts there. But what do you feel like the new normal is going to look like?
Well, I think getting the man in the street into the equity investing business has created some problems. I mean,
Mhm.
you know, yes, there's more sources of capital for startups. And when I say the man in the street, I'm at both ends. I mean, I talk about like equity crowdfunding at one
Mhm.
end and then
Mhm.
IPOs
Sure.
at the other. And I think the man in the street is more susceptible to the hype and
Mhm.
the storytelling that goes on. And I think that's created some problems. It sort of enabled the unicorn world. It was probably the part of the WeWork problem. There's just a whole bunch of issues that come about. But I, one thing that I did a little research project on this last year because one of my friends said, you know, you talk about the VCs, but the VCs invest in fewer than 1% of the companies, so they're kind of irrelevant. And I scratched my head a little bit and went off and did some homework. And the answer is that's true. I mean, you can find statistics that say it's
Sure.
0.0625% of
Mhm.
the startups or something like that that get venture capital. But if you look at the companies that go public, a third of them have venture capital back.
Mhm.
So what
I
does
thought it
that
was even
tell you?
higher than that.
Yeah, what does that tell you? I mean, what that tells me is that the top tier VCs, the guys who have been doing this
Mhm.
for a long time and really know what they're doing a great job of cherry picking the good deals.
Mhm.
They're looking at 100 deals and they're finding the one that has a pretty good shot at being a successful company, and they're doing a pretty good job of cherry picking. So to me, that doesn't mean the VCs are irrelevant at all. It just means they're doing a pretty good job of picking. And that whole theme of trying to be the one out of 100 that actually gets funded is part of what's behind my book. That's part of
Sure.
what's behind the fundable startup. Because I think I mean, some people would say, geez, they're only doing one out of 100. We need a lot of other sources of
Mhm.
capital. That's not my answer. My answer is we need more fundable companies.
Mhm. I totally agree with that.
We need more companies that are attractive to the VCs because they have their rules, they have their criteria, and those other 99 companies probably don't quite stack up. I mean,
Yeah. I totally agree with you, right? I mean, that the whole notion of what I'm doing now as my full-time endeavor is about producing a greater supply of fundable companies because you can't just, I mean, being a great entrepreneur is a skill. It's not it's not something that is just, you just sort of show up. Like you have to refine it and learn. And I mean, we were talking about, the number of boards and experiences that people like you have had and companies that you've been a part of. And that's just like that pattern is really, really valuable in developing that perspective and that skill set. And I'm sure, is a big part of your book. And so as you think back across your career and even your book, what do you feel like has stayed the same as far as what makes a company fundable?
well, probably some of the same points. I mean,
Hmm.
the guys who are really addressing a big market, they're
Hmm.
addressing a real problem.
Hmm.
uh, they have some kind of they either have an unfair competitive advantage or at least they have a good competitive advantage
Sure.
strategy that
Sure.
they have a
Sure.
good plan for positioning themselves. They understand the markets they're in, they understand the competition, and
Hmm.
they see a way to partition. The strong theme for me, and it hasn't, and this is absolutely constant, is the need for really strong management in
Hmm.
these companies at the top levels. In my venture capital experience, we funded 60 companies. So we put $80 million into 60 different companies. I did 12 of those myself. So I was the direct investor. I was the guy on the board of directors.
Hmm.
In 12, so out of 12 companies, and those turned out pretty well. There weren't any unicorns in there, but there were some 20x, 30x kind of companies. I was in
Pretty good.
Sierra Semiconductor, which
Hmm.
was a good company. Microlinear was a good company. A couple others that were bought at nice returns. but I had to replace the CEOs in 7 of my 12 companies. And I say I wasn't always the lead investor in those projects, but 7 times I basically went to the non-executive members of the board of directors and said, hey, am I the only person who's unhappy with the way things are going here? And all the hands went up, and we put together a search committee and went out and found a new CEO. That was 7 out of 12. And those were deals that supposedly had already sort of passed the test.
Sure.
So in my experience, you talk about the 1 versus the 99, the one that gets funded. That's usually the one that has the strongest, most experienced track record management team. I mean, that takes a lot of the risk out of it for the venture capitalists. So the trick is, how do I get like that? Sure. Or if I don't have that kind of experience, how do I demonstrate what I can do?
Well, and I think a lot of it comes down to coachability, and my friend, Steve Frenzinger talks a lot about self-awareness. And, there's this, I think you talk about this and write about this a lot, that there's this skill set that someone has to be an entrepreneur that sometimes actually gets in the way of them being a good CEO. So the job starts to change over time, and some people just aren't as adaptable and maybe shouldn't be. I mean, there are clearly people I've met who are really good at starting things, and they may not be for the next season or the next season the right person. And that's partly what I always say, company building is a team sport. I mean, you need boards, you need these other people around the table to really help at times look at this from different perspectives to try to solve it in the best possible way.
I think people don't appreciate, a lot of founders, a lot of founders have the dream. Oh boy, I'm going to get some background noise here. My gardener. A lot of founders have the dream that Paul talked about before we started. You sit down at lunch, you write your business plan on a napkin, you get $5 million and you go public. That's sort of the Bill Gates, Steve Jobs version of things. And it just rarely works that way. And what people, I think, don't understand, and I spend a lot of time in the Fundable startup trying to make this point. Someone who is a really good CEO, has experience and really knows what they're doing and is good at making decisions, hiring, firing, all the things CEOs have to do, probably has between 15 and 20 years of experience doing that. I've got case studies in my book of a couple people who climbed the corporate ladder from salesman at IBM or salesperson at Computer Sciences Corporation up to the very top levels, the chairman of Computer Sciences Corporation. And it's a long step-by-step process. And I don't think you can really shortcut that. Some people have good instincts. Yeah, that's probably true, but there's a lot more than instinct involved in managing a company and building a company. I mean, to me, building a company is a very specific set of tasks, and I'm not sure. I don't think you can, unless you've got really good material to start with. You can't really coach that. You can't teach that. I mean, you can't put somebody into an organization for 6 months or 12 months and shortcut a 15 or 20 year process that turns them into a truly experienced top level executive.
That's a really interesting perspective. So as you've thought about that more, how is that, or has it changed at all your approach to early stage investing?
Well, it basically is my approach. If I tell a story, and again, this is told in my book, one of the most illustrative stories is DRC computer, dynamic reconfigurable computing. The inventor of reconfigurable computing was a really good idea, very powerful idea. It kind of combines the best of hardware with the best of software, and it says, I can build a computer that can be re-architected. I mean, the fundamental architecture of the computer can be flipped on the fly, at runtime. Well, why would you ever want to do that? Well, I might like to pipeline 50,000 processes in parallel for a little while. There are a lot of reasons that you might like to do that to get very high power computing. So the guy who invented that was an expert of both hardware and software, one of very few people who could have had the idea. And he put a little company together. He got some grants, he got some contracts, built up 8 or 10 people. He asked me to join his board. And he tried to raise venture capital, but the VCs kept turning him down because he insisted on being the CEO. And he was a really strong technical guy, but he had very little management experience and not a lot of management skill. And then when the dot-com bubble hit, it took him down. And I mean, he lost contracts. He had to let go of his office and his employees. But I went to him and said, Steve, I think you've got a great idea. We can build a company here, but we're going to have to bring in an experienced CEO. So we spent a year or two and did some searching and relationship building, and we found a guy who had been the chief operating officer at Tandem Computers in Silicon Valley. Very senior, very experienced guy, kind of in between assignments and glad to do an equity kind of a deal. And he joined the company, and he worked for maybe a year or something like that before we went out for funding. We put plans together, put a business plan together. We with him at the helm, we raised $7 million in venture capital and built a company around this most powerful DNA sequencing computer on the planet. So the role I played there was to just recognize that we needed to solve the management problem and get somebody like him involved. At Novodyne, I won't tell the whole story, but at Novodyne Therapeutics, there I served as a bridge. I mean, the CEO of, at the time, Los Angeles Biomedical Research Institute came to me and said, I think the people in our infectious diseases department have a great idea, but they wouldn't know how to commercialize it. Can you help with that? So for 4 or 5 years, I played the role of CEO, which at that time meant, I'm going to shut my door here. At that time, that meant negotiating a license agreement, putting together some business plans, bringing in a couple other people, talking to some executive recruiters. And then we went out and talked to the venture capital world and raised, we got a commitment from Domain Associates for, I want to say $17 million or something like that. And part of the deal was, once we got some money in the bank, we turned on one of the top executive recruiters and brought in a CEO from the vaccine industry. This was the first fungal vaccine. It was a vaccine for both candidiasis and staph infections.
So yeah, there are those times, right? That either recognize it or you sort of structure it. I think is a really good way to think about it. But again, I mean, I think it speaks to why I feel like having those good, whether it's advisors or board members or others, investors, others around, and proactively, if you're the founder, proactively looking for that feedback of, I've heard people talk about the idea of re-interviewing for the job throughout the process to really see, like, are you still a legitimate candidate? Do you have the right skills and approach? And, the part that I think sometimes I see as a challenge is, it's one thing, I mean, you mentioned this earlier, right? Like the 1% of these or less actually are good venture worthy companies or venture capital fundable companies. But you have to approach it differently when you do that too. You're taking high pressure, expensive money, and you need to understand that fully. And I think some people maybe approach it as like getting the money is the achievement, when really it's almost like an obligation. Now you have to approach the whole company building process from that lens, as opposed to going and starting your own company and funding your own company and building it your way. You can choose to do it however you want. But to your point, the results have spoken for themselves, right? The companies that have approached it this way have had significant successes, significant growth, impacts on our world. So I just, it's maybe not fully understood on a lot of people what that actually means to go down that path.
Yeah, I think whether a company needs money or not, and how much money it needs, if you really sharpen your pencil, that's kind of a question of fact.
Sure.
I mean, just do the math. I mean,
yeah.
Sometimes some companies probably have an option of bringing in a little capital and doing some bootstrapping and getting started, and then pressing on the accelerator. They don't necessarily have to go out and raise $5 or $10 million in Series A. But the amount of money that's going to be needed and over what period of time, it is pretty much a question of fact based on your strategy. I mean,
sure.
you think through your strategy, you say, what's it going to take to build this? What's it going to take to capture the competitive position we want? And, how do we go about doing that? And what capital is going to be required to do that? And that's math usually. I mean, it's
right.
not, oh, gee, I want to do this. I want to go out and raise 10 million and put that pressure on myself, or I want to lay low and just do this myself. You don't really have that option usually if you look closely at the strategy.
Yeah, I like that. I mean, it's sort of, I appreciate that, because it demystifies what often is viewed as this very mystical type of scenario of raising institutional or venture type capital. So let's transition a little bit. I want to talk about culture and community a little bit. So as you think about, we were talking about, you've been in Southern California for a long time. You were a prominent venture capitalist based in Southern California. How do you think about the Southern California startup culture, and what are the things you feel like we should be doing to really spur more of that, to produce more? I mean, the way I think about it is it's a jobs thing. Like, how do we produce more of the innovation jobs of the future from this economy? And that otherwise we're going to have more lower wage service jobs, hospitality jobs, things that this is an expensive place to live. I almost feel like you have to orient more toward innovation type jobs just to allow the quality of life that people want to have here, right? So as you think about a culture around investing and working in innovation categories, what do you think we should be really thinking more about doing more of here?
Well, let me give you a quick answer, and then I'll
Sure.
back out and give a little more perspective. So the quick answer, if you want more companies, you want to create more jobs, I think that you have to solve this management problem. So you don't need more ideas and more patents and more licenses and more. What you need is more what I call fundable management teams. So you need fundable ideas with fundable management teams. And that's different problem than the one that a lot of people are trying to solve. So to step back, I'll answer your question in a little different way. Silicon Valley is the quintessential high-tech venture capital culture and climate. And everybody wants to copy that, all over the country. I mean, I do these Google alerts, and I do write a lot of little social media posts. And every time I look at my Google alerts, there's another Silicon Stream, Silicon Mountain, Silicon
something, yeah,
whatever, Silicon something or other.
And nobody's actually producing silicon there.
No, I mean, but it's
Yeah.
it's a it's
Yeah.
just a way of referencing Silicon Valley. And I've seen communities bring in consultants and go through a lengthy process because, well, we got the lawyers, we got the accountants, we got the universities and the technology and all this bunch of stuff. So we should be able to do just as well as Silicon Valley does. And that is, that infrastructure that exists in Silicon Valley is an experienced infrastructure. It's built around high-tech startups. And it does involve lawyers and accountants and advisors and sources of technology. You got Stanford and other universities up there, Berkeley, and it goes on and on. But what a lot of these people don't understand, and they don't include it in their calculation, is that Silicon Valley has an incredibly large supply of experienced high-tech managers. The guy across the street with the Rolls Royce has probably run 3 companies, and there are just a lot of people up there who have recycled once, twice, 3 times, and built very successful high-tech companies, and that's a real prerequisite for making that happen. So when I see that somebody out in the middle of nowhere is going to start their Silicon Nowhere, that my reaction is, where's the management coming from? Who are the people who are going to run these companies? Who are the fundable CEOs, the guys who have done it before, that are going to be able to attract venture capital to these companies? So with that kind of in my mind, there are a couple other places in the country that have come fairly close. I mean, San Diego has a pretty good concentration of biotech and experienced managers in the pharma and biotech world. Boston, in the Northeast, has a pretty good mix, probably both technology and healthcare. I have always thought of Orange County as a little bit in between there. Probably closer to the Silicon Valley model than almost any of these other ones are ever going to be, because there are a lot of experienced managers.
There are. A lot of them are getting on planes and going to Silicon Valley, right? They just choose to live here. Yeah.
I mean, there have been a lot of good companies. I mean, now there are some very successful companies that guys are going to spin out of. Broadcom as an example. You've got a lot of success, a lot of historically, I mean, I think this was true, and it probably still is, a good bit of focus on medical devices and that kind of technology. So I don't think there's a real narrow focus, but I do think that Orange County has more of a concentration of fundable managers than a lot of these
other places.
And I would say per square foot, probably more than Los Angeles.
That's a really
Los Angeles doesn't, it's a little more diversified in the business areas. It doesn't have as much technology or healthcare focus, although there's a lot of companies. But if you do it on a per square mile basis, it's so spread out. So I think Orange County is a good presents a lot of good opportunity for startups, and I thought that back in the 80s when we decided to focus 3i Ventures in Orange County, but we didn't find enough deals in Orange County to satisfy our appetite. We still ended up doing deals in San Diego and Silicon Valley. Whether that's changed, I'm not really sure. My guess is that I think there's more venture capital funds right now. I don't know the exact number of venture capital funds that are really in Orange County, but my impression is that they're not the top tier. They're not the mega funds. Not that you have to be $1 billion fund, but the guys who have been very successful down through the years are running $1 billion funds.
That's really, really great perspective. So as you think about, I mean, I would say a core part of our challenge currently is a connectivity challenge. I mean, to your point, getting the ideas with the capital, with the management, and getting that all in the same room together, because the pieces, I believe, like you said, I believe really strongly the pieces are here. So any thoughts you have on how to spur more? I mean, that's why I sort of look at it somewhat cultural and community oriented to say, okay, how do we spur more collisions amongst those different parties of ideas? Because I agree with you, we don't need more ideas, but we need to get those ideas matched with the right people to execute on it with the capital to back it. So, any models that sort of resonate with you on how to potentially do more of that?
Well, let me talk about Monday Club for a minute.
Sure. That's great.
It's not exactly our purpose in Monday Club. We're doing two things. We're giving companies a chance, two companies every month, a chance to present to three different groups. Monday Club is like 1,000 people, but in the average month we might have 60 or 70 in three different meetings. And purpose number one is to help them tighten up their pitch deck and improve their chances of getting funded. I mean, a big success for us would be a company that ends up getting funded by Tech Coast Angels, for example. And recent example of that was Lori Torres's company, Parcel Pending.
Great story.
The other thing that we're doing is on a fairly informal and low level basis, hoping that the companies that come in and present will find people in the room who can help them out in different ways. And there's been a lot of that. I mean, there's one company in Orange County that formed its whole board of directors by pulling people from Monday Club.
That's awesome.
So if we could help a company find some strong directors or the right CEO, for example, I would consider that a big success. If I were going to design an organization just to solve that problem, I would probably pull together half a dozen of the top executive recruiters and get them to participate in some kind of a sweat equity program and do a lot of networking, just with the focus on trying to bring experienced executives. I mean, the guys who are the fundable CEOs together with the companies that need the help. To me, that's the link that needs to happen. And there's not a good way to make that happen. I mean, if I was going to start a accelerator, for example, the first thing I would try to do is pull together a bunch of executive recruiters and just focus on that issue. How do we either get the right fundable managers into the company, or how do we build kind of a bridge? Maybe provide some interim management, like my story about Novodyne Therapeutics, get somebody in there that the VCs will feel good about, at least to get some funding, and then go out and raise some capital. So somehow you got to address that part of the problem, I think.
Okay. All right. I think that's really instructive and great ideas. So couple last things. I know Paul's starting to give the time sign. How are you thinking about, you've been through a number of cycles. We're in a really kind of crazy environment right now. How are you thinking about the second half of this year and even 2021 for many people who are almost saying this is a throwaway year?
Well, it's interesting. Zoom has kept us going.
That's right.
In a lot of ways. I mean, I think Zoom has helped us keep momentum. And I know Tech Coast Angels are doing their screening sessions on Zoom, for example. Monday Club is continuing to operate. We're having our meetings by Zoom. What I don't know, and I'm not sure I know how to forecast this, is how many deals are actually getting closed.
Yeah.
What impact has COVID-19 had on actually getting deals signed off? My guess is that's harder, because the diligence process is hard to do by Zoom. I mean, you can get first impressions, you can sort of decide to get started, but to really go through a diligence process is tough. So my guess is that we're going to see some slowdown in activity. I think the startups keep coming. People keep coming to us. There will be the screening sessions and a lot of process. My guess is that fewer checks will get written in the next 6 months, 12 months, maybe 18 months. But I think it'll recover. The startup industry has always been a very thin ribbon of the venture capital activity, and it's been fairly consistent. It's up and down a little bit. Yeah, crowdfunding may be taking some money away. I'm not sure that either the crowdfunders or the angels are making a ton of money. I think VCs are still doing the best job. So I think, when we look back, we'll say, well, it kind of kept going.
Interesting. So how do you keep yourself innovating and fresh?
Reading license agreements, reviewing documents I've got about 8 companies that I work with, several of which are very active right now. We got one company, I've got a call tomorrow. We're negotiating a distribution agreement for software as a service, kind of a product. I've got another one. We're trying to redefine the company, basically come up with a different strategy, different growth strategy, and that's taken quite a bit of time. So of my 8 companies, any one of them can kind of pop onto my to-do list on any given day. But there are about 3 right now, and I really enjoy doing that. I mean, I'm providing some guidance and leadership and working with some really turned on, knowledgeable, high-tech experience, well, in some cases biotech experienced people. So that's a challenge. I mean, people ask me why I haven't retired. I say, well, I retire between 7 and 9 every morning to the golf course, but for a little practice session. But the rest of the day I'm working pretty hard.
That's awesome. Well, final lap here at Accelerate OC today, Fred, and I'm so appreciative for your stories and thoughts. I always like to let my guests kind of leave a final piece of advice or key lesson that they've learned that they want to impart. So as you think about startup founders, you just were talking about how, it's much more uncertain environment right now about how and when they might be able to get funding, even if they are one of the ones that has that kind of fundable startup, fundable idea. What advice would you have for founders in my audience who are really thinking about that right now?
Well, that's a great question. All your questions have been really good, Gary.
Thank you.
Been a fun, and I enjoyed going through your list. It's a fun process. Probably the essential point of my book, The Fundable Startup, is something that I think a lot of founders don't think about. They think about their competition, who else might make the product, or who might I have to compete against in the marketplace. But they don't think of themselves as having to compete for capital. And they really need to think about it that way. The way to think about that is that investor or venture capitalist that you're talking to probably has 50 business plans on his desk, stacked like that. And a couple of them have management teams. They have good ideas just as good, just as big as yours probably. But some of those have management teams that have been successful before. They've built companies in the past. They can point to IPOs and unicorns and say, I did that, I built that. And you got to compete again. How do you compete against those guys for the $500,000, the $1 million, the $3 million that you're trying to raise for your company? And you've got to think about it that way.
Yeah, that's the first time anyone has ever shared that perspective, Fred. And I think that is so powerful and so important. So thank you very much. Thank you for joining me. Thanks for doing what you do. You've been a longtime contributor to this community, and I appreciate you for continuing to do so. You're definitely doing your part to accelerate SoCal and accelerate OC. So thank you very much.
Thanks, Corey. Keep up the good work.
Thank you.
Be with you.
You've just listened to Accelerate OC. Join our live recordings every Tuesday morning at accelerateoc.com or listen, like, and share anytime from your favorite podcast spot. Let's accelerate OC together.